Good morning and welcome from a fairly chilly Johannesburg. I hope that you're all keeping warm, but more importantly, I hope that you're all staying safe in the current environment we find ourselves in. I'm Burgess. I'm a portfolio manager at Nedbank Private Wealth, and together with my colleague Wesley Bester, who heads up the derivatives trading team, we will be your hosts through this morning's session. While we're connecting with you online in this way, it's important to reflect on connectivity and connections in general, but especially when it comes to our money and financial matters. At Nedbank Private Wealth and Nedbank Financial Planning, we use our globally integrated and advice-led approach to connect your financial decisions to your goals and aspirations. The reality is that every single financial decision that we make affects not only our ability to protect what's important to us, but also to achieve our goals and dreams. At Nedbank Private Wealth and Nedbank Financial Planning, we make these connections more visible and therefore more manageable. But what does this mean for you as a client? It means that we connect you to technical expertise, a global perspective, appropriate opportunities, and access to solutions and services from across Nedbank and other top providers. But most importantly, we connect you to the personal and objective advice you need to make your money decisions count. And practically, this is what we mean when we refer to connected wealth. As the title of today's webinar suggests, our guest speaker, Pieter Geldenhuys, will give us a glimpse into some of the possibilities that the future may hold. More importantly, he will be taking us through some big structural themes that are currently playing out and explain why some of these developments are so exciting, not only for us as human beings, but the implications this has for the way that we invest our time and money. When I think back over the last 10 or 15 years and have a look at some of the structural shifts that we've seen in different industries, I was reminded of a time not too long ago where there was a lot of excitement around Facebook and the possibility of its listing coming later that year. I'm sure a lot of you remember the excitement and hype around the Facebook IPO in 2012. What I needed to remind myself about, however, was at around the same time there were some serious concerns amongst investors as to whether Facebook, which at the time was very much a desktop-driven type application, whether it could adapt to the upcoming shift to mobile. If only a small group of people bought into the idea that the internet would be as revolutionary as it has been, an even smaller group could have predicted the shifts toward mobile. An even fewer group of people would have imagined a world where from a handheld device you could summon a stranger in their car and they would be there in the blink of an eye. For a small fee that would be charged directly to your credit card, the stranger would happily take you from point A to point B. Not only that, you could rest assured that the stranger's vehicle would be reasonably clean, it would be roadworthy, and you could listen to whichever radio station you fancied. Uber was founded in 2009 and has a market cap of $94 billion. Facebook listed at $38 in 2012 and today is trading at around $340 a share. Outside of the business that is Facebook and Uber and the returns that they have provided for shareholders, I think both companies are great examples of the speed and impact that these structural shifts are having on the way that we live our lives and manage our money. I have no doubt that what Pieter has to tell us today will provide further color and context to the complex but exciting environment that we're currently operating in. And it's now more important than ever to partner with financial experts who do good. Pieter, a very warm welcome, and we're certainly very eager to hear what you have to say. But before I hand over to you, if I could quickly run through some important housekeeping notes. On the structure of today's session, once Pieter has taken us through his presentation, Wesley will be running through some of the questions that we received in the run-up to today's session. Please use the Q&A chat box on the left-hand side to submit any questions that you may have during today's session. If your screen happens to freeze for whatever reason, please press the refresh button and it should take you right back to where you last stopped in the webinar. You'll receive an email in the next couple of days with a link to the recording to the webinar. Hopefully you'd like to watch it again, or perhaps you could share it with friends or family. Please remember that you can get more thought leadership insights, the recordings of previous webinars, and find out about future webinars on our website. Lastly, your views certainly matter to us. Please help us improve our future webinars by giving us your feedback in a brief survey that you'll receive after today's session. I'm very excited to introduce to you Pieter Geldenhuys. Pieter is the founder and director of the Institute for Technology, Strategy and Innovation. Over the past 2 decades, Pieter and his team have guided more than 4,000 students and more than 120 innovation projects within the largest technology companies in India, the Middle East and Africa. Pieter was the previous technology strategy advisor to the CEO of Vodacom, vice chair of the Innovation Focus Group at the International Telecommunications Union in Geneva, Switzerland. He is also a nominated member of the South African Academy of Science and Arts and vice chairman of the RTO CARFIA. Pieter is a renowned futurist, academic, and innovation expert. He has a degree in electronic engineering, an MBA specializing in technology strategy. He's also an adjunct faculty member at the Northwest University and a regular guest lecturer at the London Business School. Pieter, it sounds like we're in great and very capable hands. Over to you.
Thank you so much for that introduction, Kyle. A hearty good morning from a very cold Stellenbosch. And yes, I'm going to share with you some insights, some of the weak signals we're detecting in the market out there that might just impact our lives in the next decade or so. But without further ado, let's get cracking on my presentation. And let me give you a couple of insights into what you can anticipate over the next 40 minutes or so. So yes, you've heard that I'm a futurist. What the hell does a futurist do? Well, what we do is here's the academic definition, we intentionally build capacity to see and understand the implications and meaning of change. But what it really means is that, yes, we take a look at the news headlines happening all around us, and then we try and identify which of these weak signals might become more important in future. So I might literally take a look at a couple of weak signals. And the way we normally structure these weak signals is to take a look at the words of William Gibson, the author of Neuromancer. And he said, the future has already happened. It is just unequally distributed. So yes, we can sometimes predict the future, but unfortunately, it's unequally distributed. And one of the key examples was the outbreak of COVID-19, having a huge impact on the world around us, on a variety of industries, where we had a disruption not only on the supply side, but on the demand side as well. We had weird things, even here in South Africa, with robots cleaning our hospital rooms with UVC rays. But I think one of the biggest impacts we've seen over the last couple of months is the so-called bullwhip effect, where we had a just-in-time ecosystem with supply chains all around the world, and suddenly there's changes on the demand side, where we're staying at home, we don't travel as much, we don't use our cars as often, yet we order out food quite more often, and yet we buy different things. On the supply side, a shortage of chips. And this is literally creating an environment where there's an abundance and a shortage of certain products over time. And this literally plays havoc with the short-term inflation figures. So the bullwhip effect is something that will be with us for the next 2 to 3 years as we try and make sense of this changing world post-COVID-19. But let's go and take a look at some of the major trends and perhaps sometimes some of the weak signals within these trends. And firstly, let's go and take a look at demographics. So when we take a look at demographics, we normally hear the story that there's this unbelievable growth in the world population. What's really, really interesting is that if we take a look at the figures over the last couple of years, or the last couple of centuries, before 1800, there were less than 1 billion people on the planet. And then suddenly we had this exponential growth in humans. Between the year 2012 and the year 2020, we added another 1 billion people to the planet in 8 years. So literally a change in our demographic figures. But if we take a look at where this growth came from, it was normally or usually in those 3 countries you see in that little circle: Indonesia, China, and India. But the story on demographics is going to change over the next few decades, because this is what's going to happen to Africa. There's an estimation that we're going to move from about 1 billion people to more than 3 billion people on this continent by 2100. And this is the picture we see here in South Africa, with a declining rate of births. So that's literally the picture over the next few decades. A massive increase in the population of Africa, but a decline in most of the other continents and even in Asia from 2050 onwards. So if we take a look at the world and we compare it between the population density in the year 1800 and then compare it with what we anticipate in the year 2100, look at that. Massive increase in Africa, a decline in China, steady growth in the US, but look at Europe. A massive decline in Europe. And I think that's one of the key messages that we need to talk about, because the growth rate is literally falling. A quick overview of what's happening in China. This is quite important, because in this world of consumption, where the economic models is based around the consumption economy, we thought, hey, China's going to pick up the slack. Massive growth in China in the 1950s, the 1980s, and then the one-child policy came in, and look at what happened after that. a massive decline in their population. Now, this is really, really important, because what's happening in this scenario is that certain schools are built, cities are built, with anticipation of a number of people within that age bracket. And suddenly, in the next generation, 30% of them isn't there. Imagine building schools and universities for this group that's coming through the economy, and then in the next 10 years, there's a 30% decline in it. This is literally what we've seen in China. So it's absolutely no wonder they've got a 3-child policy rather than a 1-child policy, because if this continues, the Chinese population will halve by 2100. And this means that they will not pick up the consumption patterns that we anticipated them to do. There's a very large possibility that China will grow old before they grow rich. Similar scenario is being faced by Japan. In Japan, they're selling more adult nappies than baby nappies. And this means that the number of people that have to work to pay taxes to sustain those that are retiring, we are looking at a post-industrial society and a demographic cliff. But not only in Japan, we're seeing the same story playing out in Germany, in Italy, and also in Europe. And this is a problem, because if we take a look at the demographic decline, and if we take France out of that equation, France is not looking too bad, but taking France out of the picture, take a look at the decline of the population in Europe. A rapid decline. And we're going to bring that back to monetary policy in about 20 minutes from now. A rapid decline in fertility rates in rich countries around the world, or the so-called developed countries. This is literally the scenario that sums it up. People growing older with a declining population, with a declining birth rate. So why is this problematic? Well, it's problematic because of our consumption and expenditure patterns. You see, we need rich 25-year-olds. That's literally what drives the world economy right now. Because at age 25, you get married, you get kids, and then it's spend. You sell your sports car and you buy a mommy wagon or a daddy wagon, depending who takes the kids to school. So literally, at that point in time, when you get kids, you buy a new home, you get refrigerators, you get data plans, you buy technology, and that's where the start of the consumption pattern begins. Literally at age 25 until about the age 40 or 45, that's when you spend. And at age 45, you start spending less, because that's the peak. And then you start getting ready for when you go on pension, where you save every bit of money that is coming your way. So that literally is what we look at. But the problem is, what happens in economies if there's no 25-year-olds, or if there's a 30% decline in 25-year-olds? Now, it takes a long time to get a 25-year-old. Those without kids, you can answer that question, but it takes a long time. And that means that if we don't have 25-year-olds in economies, that means that the consumption patterns will literally change radically over the next few decades. So we are anticipating peak consumption to be reached somewhere in the next decade. That means that in the years 25 to 2030, we're going to reach peak consumption, and then that's going to start declining. And this is important because our economic models in open market societies were balanced around two patterns of thinking. On the one end, we had the Austrians, the Schumpeterians that says, we can create economic growth by being innovative, the animal passions and unlocking new opportunities in innovation. And through that, the value of our economy will rise as our productivity increases. That's the supply side mindset. The demand side mindset says, no. Let's print extra money. The extra money in the process will pull through the products through the supply chain that will create a demand, the so-called Keynesian school of thinking. And it looks like the entire free market world like this Keynesian thing because, politicians can come in, they can ensure that there's money available, demand is activated throughout the value chain. And this literally means that in our consumption-led economy, where a large part of our economy is based on consumption and spending, if that starts to decline, it'll have a huge impact on our economic models. That's really something we need to look out for. So this is part of the journey that we might hit peak consumption in the middle of the next decade. So the IMF is very optimistic, as they always are, about the growth of economies. But if we compare that with the decline of 25 to 49-year-olds over the next few decades in Italy, we see a completely different picture. Only time will tell to see what really happened. So if we take a look at the world and where we have increasing birth rates, we literally have the US in the middle of Africa, and that's about it. Talking about the US, they're one of the few economies with a positive demographic. So that means that the consumption patterns are quite strong, and they know it. So that's why they play hardball with trade, because they literally have the consumers that the rest of the world is looking for. So, you know, the engineers in Germany that are getting older, they know what they're doing, but they like to export their goods, and they want to export it to people that can afford it. This is why the US will play a far larger role in world trade as far as consumption is concerned. That's the rest of the world without the US. And that's why we believe there will be peak consumption in the rest of the world in the next couple of years. So let's go and take a look at geopolitics to see how will these demographic shifts play a role in geopolitics. And well, it all starts with a Bretton Woods agreement somewhere in the Second World War. So what happened at Bretton Woods? Well, you see, America bribed a number of countries to stand in front of it because they realized the Soviet Union is going to be the real threat after the war. So they bribed a few countries and said, what we in America will do is we'll make sure that you don't have to connect your currency to gold. We'll do it. And then you can connect your currency to our currency. And what we'll do is we'll create a security umbrella around the world, making sure that your trade is safe and also making sure that your energy security is safe, because you'll be able to buy oil using dollars. And that started Bretton Woods, and a tremendous amount of countries benefited from this. I mean, after the war, there was only really one large economy whose production wasn't interrupted, the US. They weren't attacked, their production capacity was intact, and they literally allowed this growth to start emerging all around the world, led by labor-led growth rates. And we saw countries like Germany and Korea and Japan prosper in this ecosystem. But for America, Bretton Woods was always about security, never about money. And that's about to change. Because if we take a look at global trade, what we are seeing is that the US exposure to imports and exports is only about 13% of their entire economy. And if you take Mexico and Canada out of the picture, it's 5%. That's quite scary. So here's America that needs to keep the world safe, their global trade routes open, and yet the benefit they get from it is 5% of their GDP. Why should they fund the rest of the world's security umbrella if the benefit they get out of it is minimal? And that's the problem, because the moment that they move out of the Bretton Woods system, they might stop protecting the world's trade routes. And this will open up a whole new can of worms as far as piracy is concerned. So watch out for the space. It's going to be interesting. So on the one end, it's security in terms of trade security. On the other end, it's energy security. So let's take a look at oil shipments out of the Middle East into America. And you can see that over the next few decades, a rapid decline is taking place. So I do apologize. I think I had the wrong slide on. I had my face on rather than the slide deck. But that shows you what happens in terms of America's trade. A very, very small part of their GDP is linked to exports or imports. So when we take a look at energy security, a rapid decline in the amount of energy that is exported to the US over the years. And right now, America is a net exporter of energy. The fracking was quite successful. You can see the Bakken Formation on the left top. And that is literally the amount of gas that they flare, because America doesn't have infrastructure to transmit the gas via pipelines to people that will use it. They're busy doing that for the Mexicans right now. But that's the amount of gas that they flare. Unbelievable amount of gas that they're not even using. So the fact that they don't need the oil as much as what was needed in the past, we are seeing a decline in America's military deployments around the world. And this means a whole new game of poker. Oh, the professional poker players will know if you want to take your opponent down, two people on the poker table can take a third person down, and that's literally global poker. That was realpolitik in the 1970s, and also why the United States recognized communist China to act as a counterweight against the Soviet Union. That's realpolitik. But how's this realpolitik playing out right now? Really weird. Like the Congress that's trying to block a pipeline coming from Russia into Europe. How weird is that? Why would America be interested in trying to kill the Nord Stream pipeline? So under the Trump administration, that was one of the priorities, to stop the Nord Stream pipeline, which is about 90% built. And that is because it bypasses Ukraine, but also because America is asking itself, why do we need to pay so much money to put military personnel in Europe to protect Europe against the Russians, while the Europeans are buying their gas from Russia rather than from us? Interesting question, isn't it? So that's the world of real politics, and let's see how quickly that plays out. What happened in the year 2000 is that rapid decline in population after the financial crisis in 2000, and you can see the impact it had on Russian demographics. The problem is that the armed forces of Russia will halve in the next 10 years, and they are quite scared. They've been invaded something like 30 times over the last 500 years. So they're really worried about protecting their borders. And this is why they've got these interesting exercises into the Ukraine. You see, if Russia can push forward closer to the Dnieper River, there's only about 11 bridges that they need to protect. But right now, they need to protect something close to 500 kilometers on the Ukrainian border. And with declining armed forces, this is their rationale of getting involved in the old Soviet republics. We're also seeing weird changes in the Middle East as new power blocks are emerging to counter the fact that America is moving out of that ecosystem. We have Israel and Turkey, for example, joining forces so that they could harness the Aphrodite gas field and plug it into Turkish pipelines going into Europe. A couple of interesting scenarios on geopolitics. But enough about geopolitics. Let's go and talk about China. Now, what I'm talking about in terms of Bretton Woods and where the Bretton Woods system is going and the challenges we face in it, China is well aware of it. And what China did is to start with something similar, but on a smaller scale. And they called it Belt and Road. So in terms of Belt and Road, they created an ecosystem where they had energy security coming from the Middle East, but also unlocking new opportunities in Asia as well as into Europe. So some of the work that we are doing in the Middle East is looking at the Melaka Straits. Really interesting because Melaka Straits will handle close to about 80% of China's energy imports. And it takes a good 4 days to navigate the Straits of Malacca. So one of the interesting scenarios we're looking at is, yes, you guessed it, a new canal all through Thailand. Because if you can have a canal similar to the Panama or Suez Canal going through Thailand, it'll cut out 4 days in terms of the entire supply chain. Unbelievable opportunity to unlock new value. So watch out for Thailand becoming a very interesting destination, even for Middle Eastern oil companies that can put refineries on the one border and then put a pipeline through the other to the other end, allowing China to unlock new opportunities as far as energy security is concerned. What else can we anticipate? Maybe a change of season? Well, for those that believe in generational theory in the world of Strauss and Howe, there might be a change in generational theory where we might get a whole new generation of individuals entering our ecosystem. So yes, that's one of the waves that people are looking at. I actually like the economic waves a lot more. So when we take a look at our economic models, we've seen an economic model that was labor-driven after the Second World War, mainly aimed at creating jobs. And this led to this. And then as a system builds up, the reaction against the system starts building up over time. That's in essence what happens in our society. You know, we create a system and then there's a reaction against the system and a new system emerges. Think of an economy as a computer, as a microchip and a processor. And every now and again, every 30 years, it drops and then we pick up the pieces. And it kind of makes sense all over, but there's a new operating system and a new way of doing things. And this happened after the Second World War. We had the huge inflation in the 70s, and we started organizing creating a whole new capital-driven international capital model that replaced the labor model in the 1970s. In all honesty, everyone believed it'll last until about 2010, and there would be a shake-up after the global financial crisis. But what happened? Quantitative easing. And that means the But the old system is still on life support with some really, really interesting things happening over the last 10 years. We're going to talk about that and the impact of that in a moment, because one of the biggest impact was the increase in debt, international debt. 1971, you all know what happened. America decoupled itself from the gold standard and money became fiat-based. What actually happened is an unbelievable increase in the amount of money, and yet the growth of our economic system lagged quite significantly. And this is literally what we saw over the last couple of years. We saw this lag in the economic system with a huge amount of debt emerging all around us. So this was the result of Charles de Gaulle saying, I want my gold, please. And unfortunately, America spent a hell of a lot of money in Vietnam. And they couldn't afford to literally pay back the French the money that they had linked to their gold. And that meant that a fiat currency was born. So a huge amount of debt emerged all across the world. And this is most notably happening in Europe as well as a number of other countries. If we add up all the debt around the world, this is personal debt, banking debt, non-financial debt, and government debt, we are seeing unbelievable figures. Now, one of the interesting things we need to realize is that we as humans love playing with numbers. You know, when we talk about a billion and a trillion, oh, it's 22 million. Oh, what's 22 billion? Oh, it's 1,000 times more. And 22 trillion, oh, it's just another 1,000 times more. But if we compare that to time, we get a completely different picture, because a million seconds, it's about 11 days. A billion seconds is 33 years. A trillion seconds is 33,000 years. And if we take a look at the current debt all around the world, it is scary. So we spoke about the advantage that America has, but all of the rich countries are in the glue factory. If there were horses, they'd be in the glue factory, but America would be the prettiest horse in the glue factory. These figures were pulled from the web about a year ago. And that was when America had a debt of $23 trillion and unfunded liabilities of about $130 trillion. Unfunded liabilities, that's the pensions they need to pay out to their firemen and teachers and policemen, everyone that works for the federal government. This is the picture I pulled out this morning, $28 trillion. And that is quite concerning, because this huge amount of debt means that something has to give. One of the biggest problems, or one of the biggest challenges that we have is we don't really know where money comes from. And it's a bit of a debate. And the real insight is no, money is not created by the Fed or the central bank. Money is actually created by the primary dealers, the banks. Because if you as an individual go to a bank and say, hey, I want to buy a house, the bank would then create a loan for you. You will pay it back over 20 years. And then after 20 years, that debt would be wiped out, and the bank would make a bit of money from the interest that they would charge. But what we are seeing happening around the world right now is that the Federal Reserves all around the world are literally buying the debt. And they call it quantitative easing. And by buying this huge amount of debt from the banks, this doesn't really mean that the Federal Reserve creates money. They literally monetize debt. So the debt that has to be paid off is now monetized to provide liquidity to all of the banks around the world. And because of this liquidity, the interest rates are kept low and money is readily available. And that was one of the important impacts of this quantitative easing process, where the central bank simply monetizes the debt and provides liquidity for long-term value. So here's one of the interesting insights. A massive fall in the velocity of money, while the amount of money in the system is rising significantly. And in the end, it ends up at this very interesting graph. Let me explain what happens. Because money is so cheap, but unnaturally cheap, because of the amount of liquidity in the system and the amount of monetization that the Fed is acting out on, we are seeing that a number of companies want to increase the value of their companies. And the one way of doing it is to do share buybacks. So if money is cheap, let's go and borrow money, buy back shares. And that literally means that my price earning ratio or the earnings per share can rise significantly. You all know how the game works. If I have 100 million profit and I've got 1 million shares in the market, I've got an earnings per share of $100. But if I buy back 500,000 shares, the shareholders like it because they get a lot of money in their pockets, and those that retain the shares have got shares with increase in value. So if I have 500,000 shares in the market, I now have earnings per share of 200 while my revenue still stays the same. And that's literally what you see on the screen. The green line, gross domestic product, staying the same. Very cheap money, but look at the valuation of shares. It's skyrocketing. And this is the scenario where we're in right now, where the normal price-earning ratio in the market would be about 19.5. In the US, it's close to 38. So the price-earning ratio, so imagine this. A world where we might face peak consumption, where the number of people in our economy will decline, that will drive our consumption economy, so rapid decline in our consumers. These individuals will have to pay the taxes not only for the pensioners that are retiring, but also for the debt that the government has undergone in the past, plus the amount of money that has been created or monetized, because most of the money that is being created right now is based on debt, because the Reserve Bank buys the debt that the banks have created. So this is literally a very interesting scenario. So it's absolutely no wonder that the economists have said that the rules of the old game is no longer working. A strange new world of economic rules have emerged. So what's the impact of these changes, the so-called cheap money we have in the system? Well, might it be inflation? We see some inflation in some sectors of the economy running away, but I think the biggest impact is literally generational wealth. This interesting picture sums it up. It says that when the baby boomers hit 35, approximately 30% of them had a home. When the Generation X's hit 35, 20% of them had a home. The millennials are now hitting 35. Only 4% of them own a home. So what we are seeing is that we have a world where our asset prices increase, share prices are going ballistic, home prices are going ballistic, debt is going ballistic, and the real pressure in the system is boiling into a social construct where a number of people are saying, both of us work and we can't afford to stay alive because it's becoming too expensive to buy a home or to buy assets. So this is a very precarious state we're in, and no one can really define the current economic order we're in. If the Economist magazine, one of the most authoritative magazines in the world, is saying strange new world is opening up, I'm just reflecting on what's happening. So this is some of the negative elements that we see in our market, and yet on the other end of the scale, some unbelievable opportunities. There's a fantastic video on the economic world order. A guy called Ray Dalio, he brought out a video a couple of years ago called How the Economic Machine Works. Something really interesting to look at if you want to have a key insight into some of the changes. So what are some of the predictions or the weak signals that we get out of this current environment? Well, one of them is programmable currency. I don't know if you've heard of the Yup Islands. So there they had a monetary system based on the size of rocks, by the way. You couldn't get these rocks on the island. You'd have to go to neighboring islands to get it. But if you owned this big rock, you were rich. And later on, these rocks were so big that those that owned the rock didn't take the rock with them. They simply just put their name on the rock. So what was really interesting is that when the Germans had a stint in running some of those islands, they wanted the islanders to get involved in building roads and bridges, and the islanders said, no, not a chance. You know, we like our laid-back life. At which point in time, the Germans nationalized these stones and said, okay, now we'll put the German government name on it, and after you build the road, we'll give you the rocks back. And yes, they did it. So we might think that's really weird and funny, but that's exactly what happens with our gold. You know, in 1971, here was a bunch of rocks and there was a name in front of it saying US gold. And then we took our name and we put French gold on top of it, and then everyone went into a tiff. How weird, the world of money. But it even gets weirder. Let me go back to an interesting case study in the town of Burgess in 1933. So what Burgess did is they didn't have any money. So they had about 40,000 shillings. They took the money, put it in the bank, and they created their own promissory notes. But this was interesting because these notes were demurrage based. What do I mean with that? It means that these notes lose value every year or every month. and you had to pay 1% to actually retain the purchasing power of these notes. How weird. And can you imagine what happened? What happened is that no one wanted to keep these notes, because the moment they had it, and if they had it at the end of the month, they are the ones that have to put the 1 cent tax on it. So they just spent this. What happened? Where you normally have a velocity of money about 9 or 10 times through an economy, suddenly the velocity of money went to 300 times. This meant that entire town was booming. They were building roads and bridges, and everyone was spending this money. And then all the other towns in the vicinity said, how the hell did you get it right? Where did you get the money from? They said, no, we didn't. We took this money, put it in a bank account, and then we created these promissory notes. So all of the towns copied them, at which point in time the federal government said, whoa, stop all of this, because if no one is using the national currency, that might completely debase its value. One of the important things we might see in the future is programmable currencies by government, centrally banked cryptocurrencies. And this is literally what's happening in China right now. What's really important is that you might get stimulus checks. Someone might give you a bit of money, but the problem is if you don't spend the money, you might lose some of its value. And that's really interesting, that we might enter an era of government-backed cryptocurrencies where it's programmable. And there could be a 1 or 2% tax depending if you buy anything from a green company or if you don't use the money as the government intends you to use it. Really, really weird. Let's quickly go take a look at a couple of interesting things that might just unlock opportunities. I've got about 10 minutes left, and I think I've depressed you enough. Let's talk about the positive side of what's happening. We might just become a level 1 civilization on the Kardashev scale. So for those of you interested, go check out the Kardashev scale, where we might be able to harness all of the energy that dissipates into our atmosphere from our local star, the sun. Well, we're a couple of 100 years away from a type 2 civilization where we will harness all of the energy from the sun. Think of a satellite network all around the sun to zap back energy to us. Or a type 3 civilization where multiple energy sources might happen. For those of you that want to know where this comes from, it's Space Odyssey 2001 and 2010 was based on this philosophy. If you want to look for alien life, look for a star with a satellite ring around the star itself. But nonetheless, where are we? Currently, we're a type 0 civilization. Why? Because we burn everything in order to sustain ourselves. But very soon, we might start with nuclear fusion. And this is happening in the south of France, the International Thermonuclear Experimental Reactor. And within this tokamak, we can create what's happening on the surface of the sun, where we take light isotopes of hydrogen, smash them together, and get helium and energy out of it. You need a very strong magnetic field to contain that reaction, because it's so hot it might actually melt the outside of that vessel called a tokamak. But hopefully, we might just have an energy breakthrough that will change our world forever. There's competing products in China as well as in Germany at the Max Planck Institute. And some of us are saying, why don't we use our existing fusion reactor called the sun, where we can power our cars, where we can even generate electricity while it rains by harnessing the raindrops. And a massive decline in the price of solar energy and renewable energy. What's really interesting about 1.5 years ago is that Germany, for the very first time, paid people to use electricity because they were worried that the energy grid's going to blow, mainly because they were generating more energy than what they need. And because of that, the guys in Belgium are now busy building a dam in the middle of the sea to ensure that they can have extra energy when they need it. How weird is that? A dam in the middle of the sea acting as a battery. A truly weird world. Some of the interesting things we're going to be seeing in the next couple of years is a new guerrilla game. What do I mean with that? This means that one company will control a world standard, similar to Windows controlling the operating system on your PC, Android or Apple controlling the operating system on your phone. The new guerrilla game is in virtual reality, the 4th installation of the information society. And this means that our idea of hybrid work might change. By putting on a pair of VR goggles, you don't have to worry where you go in order to work, because you can simply work from anywhere. This is the vision of Microsoft, where you can put on augmented reality or virtual reality and literally be in a different location. You can meet up with someone, share ideas with them. You can sit next to each other and create a new reality right in front of you to share ideas in 3D. And what you're seeing here has already been a reality for the last 5 years. Those HoloLenses, they go for about $3,000, quite expensive, but unbelievable opportunities are being unlocked as we speak, as we literally can create an ecosystem in front of our eyes. What is also important to realize, however, is that this is not the future. It already happened. For those of you that has got an Oculus Quest headset, you can buy this for about $299, imported into South Africa for about 6,000 Rand. You can literally put it on and go and look at a gallery exhibition or meet up and chat to your friends. I normally do it to play games with my kids when I travel abroad. We even have created our own gallery. We call it the Road to 2050. And if you want an invite, just send me an email. And if you have a headset, I'm more than willing to show you what we've done in our gallery. Every now and again, I also hook up with a couple of friends, sit around a campfire, and talk about life. So, yeah, if you're interested, let me know, and I'll host you at one of my fireside chats. The world is quite interesting. A couple of other key elements that will shape our world is also, yes, you guessed it, a repositioning of the Amazon Alexa smart speaker. That's the other gorilla game, where in VR and AR, so in virtual reality, we are seeing the Oculus from Facebook becoming the dominant platform. In augmented reality, we see Microsoft HoloLens becoming the dominant platform. And in intelligent speakers, Alexa by far is the dominant operating system. But one of the interesting technologies on Alexa is Sidewalk, Amazon Sidewalk. This literally means that you have a 1 kilometer range around each speaker or each camera that you have, and it can pick up Internet of Things devices. The problem with IoT is that the battery life dies quickly if it has a long distance to travel. But if the entire neighborhood has got these small little picocells all over, you can literally put a tag on your dog and track it for 10 years before the battery dies. Watch out for Amazon Sidewalk. Over and above that, we all know that the Starlink satellite system is going to give it high-speed connectivity with nanosatellites, which brings us to the last topic of today, the next generation internet. With cybersecurity a massive constraint, a number of people are saying, how the hell can we create a more secure internet environment? And yes, you guessed it, they're using quantum entanglement. Now, what the hell is quantum entanglement? You take two photons. Now, this experiment they've done 80 years ago, so it's not new. You take two particles, let's say two photons, you entangle them. Once you entangle them, they have opposite spins, but you don't know what spin they are. And then you can take the one particle and send it to Mars, and you still don't know what the spin is. And then someone on Mars looks at this particle, and the moment they look at it, this one is fixed. This is weird. And how the hell do these things communicate? Einstein called it spooky action at a distance. Two particles, you don't know what their spin is, but the moment the one looks at the one particle, the other one's fixed. How does it work? Well, we don't really know, but it works. So at the University of Vienna, they've literally taken a couple of images of these two particles as they interact with each other, the quantum entanglement, and as the one spins, the other one is automatically the opposite of it. And they literally can be removed millions of kilometers from each other. This is one of the fascinating aspects of the world of subatomic physics. And what's really interesting about this world, this horizontal and vertical polarization of these two particles, imagine using that in modern communication systems. Imagine using this in order to secure our keys. Imagine if you are sending, so one of the problems we have in cybersecurity is that the keys that we share with each other can be hacked by quantum computing. But what if we share these keys on a daily basis? The problem is we don't know if someone is going to hack into our communication system and find out what our key is unless we use quantum entanglement. So what if we use quantum cryptography? And as you send the keys to the various partners, all of these particles are entangled. The moment it is received, we know they're still entangled because the entanglement hasn't been broken. But the moment Charlie comes in and hacks our communication signal, what happens? The entanglement is broken. And now we know someone is looking at the key that we're sharing on a daily basis. And then we just change the route at which we send the key. The moment the route is changed, then a new key is provided on a daily basis, creating a far more secure communication environment. And I know for a fact, a lot of the South African banks have already implemented some of this on the critical links, but this might become the foundation of a future internet as we are getting far more cyber hacks. So watch out for quantum cryptography. And we might even see that technology playing a role in radar. Instead of getting a reflection of a specific target, we might just send a particle to the aircraft. And if it doesn't bounce back, the particle and the focus that you have on the particle that you look at that is entangled can literally see that that particle collided with something, although it's not bouncing back. A whole new era is opening up. Lastly, last picture, the Higgs boson vector we've identified in 2012. This literally means that particle that gives mass to everything around us. And right now, we are able to use mathematic modeling to create a subatomic world of new materials, which means that you might even have a car where the body panels of the car might store some of the energy, with smart materials unlocking huge opportunities. Where are we right now? We're in a world where some of the largesse of the past is balanced against the possibilities of the future. This is where we are in terms of our investment as well. Are we worried about the huge amount of debt and the inconsistencies within our economic models? Are we looking at the opportunities of new technology which will create untold wealth? That's the challenge we all face, and something that we have to ask our financial advisors what they think the best route might be. It has been my honor and privilege to share some insights with you, but I'm going to hand over to Carl. Let's see if there's any questions on the dock. Carl, over to you. Thank you, Wes. Thank you, Carl.
Thanks for that brilliant insight there, Pieter. It's Wes here. I'm gonna be handling the Q&A session. Again, good morning to all of you. Thanks for joining us on this webinar. As Carl mentioned earlier, we presenting from a chilly Joburg, where we've had some cold weather and some rampant COVID cases, myself being a recent victim, while Pieter is joining us from a rainy Stellenbosch. Hey, Pieter?
That's correct, Wes.
Okay. I'd just quickly like to introduce myself before I handle the question and answer portion of this webinar. Carl gave a very soft intro to me earlier, so I thought it's best I just spice it up a little more. I'm on the stockbroking side of the business at Nedbank Private Wealth, and I run the derivatives trading desk, which is all the risky business, I guess, that no one else wants to manage. In staying with the times and adjusting back to lockdown level 4, I did my final preparations for today's webinar last night, opting for that home haircut, so I could look half the part today, as well as just demonstrate how live this webinar actually is. I think it was a well-calculated risk on my part. We've had numerous questions coming to us prior to the webinar, as well as some live questions coming in, which I'm seeing on our screen. I'm going to try my best to just get a mix of both these questions, so we can just combine these and get the best answers to all of you. I think Nedbank is hoping that I can obviously handle these questions as quickly as I handle my trading in these volatile markets. Just some quick housekeeping from my side. All questions are anonymous, so yeah, don't be scared to ask away. We're going to do our best to get through as many questions as possible. And then if we don't get your questions, please feel free to just drop us another message with your email address, and we'll get back to you on those. What I'm going to do is I'll read the questions out, and then I'll direct it to either of you, Pieter or Kyle. And then I think it's best we just try and stick to our time limit allotted to us for this Q&A session. So if you can keep your answers, short and sweet. And then if we need more clarity, I'll draw some more info out of you. And then where I can add value, I'll definitely jump in. So I think let the games begin. Question 1. What is the speaker's opinion on investing in renewable energy projects in South Africa? Pieter, I'm gonna hand this question over to you.
If we take a look at North Africa, we're seeing really low costs, something like 1 American cent per watt, really, really low costs. And therefore, if you want to invest in a renewable project, make sure that your contracts allow you to make good profit, because we see a declining cost, and that if you spend a lot of money in the current context, maybe 2-3 years later, someone can offer energy at a lower price than you do. So make sure your contracts are fixed, that you have a fixed scenario pricing. If you consume energy, it's a no-brainer, because you can literally unlock a whole bunch of value. But I think the policy framework will guide a lot of that thinking, as well as the contracts that you sign that will guarantee your future investment. So those would be two things I'd consider. The policies, who do you sell it to, municipalities or government or whatever, and then also the contracts that you have in terms of the revenue you will obtain from that energy. So that would be the primary consideration.
Okay, thanks, Pieter. Pieter, the next question is actually pretty close to home for me, as I've got two younger siblings, laatlammetjies, as you'd call them, and they're actually entering their tertiary education journey right now. And we're getting a lot of questions posted to us about, what should our youth be studying in the, to prepare them for the future, and just the world where we're going. So, I mean, if you can just guide us on that, Pieter, and then I'll definitely be calling my sisters tonight to give them your guidance.
It's difficult, I like to provide value to someone based on their personality and what they like, rather than just glib analysis of what the future might hold. But nanotech, unbelievable things in smart materials, computational social science, where we don't do predefined categorizations, but let the data speak to us. Huge opportunities in innovation, technological innovation, messenger RNA, huge opportunities in epigenetics and in healthcare, where you really focus on a healthcare system, not a sick care system that we're really in today. So, keeping people healthier for longer. So there's a number of fields opening up in the new tech space. It literally would be an hour presentation on its own to highlight some of those. But here's some of those key elements that might unlock a lot of value in the future.
Okay, thanks, Pieter. It's a pity you didn't state that they could be influencers on Instagram, because they've got a real passion for that. But let's move on to the next question, which I think is on a lot of people's minds. What are the presenters' views on cryptocurrency and blockchain technology? Pieter, you can go for it, and then Carl, maybe you can add some Nedbank flavor after that. Pieter?
So I'll be quick. If we take a look at the traits of money, is it verifiable, fungible, portable, durable, and we compare fiat money with gold and Bitcoin, we literally can see an analysis. What the challenge is that there's a definite bunch of value in cryptocurrencies, especially those top flight ones, the Bitcoin ecosystem. But the problem is it doesn't have a long established history, and we haven't seen it go through recessions or depressions to see how the market really reacts, because sometimes it's binary. If you take a look at the value of the Zimbabwean dollar, it was binary. We don't know what the long-term play will be, but there is definitely a number of benefits on the more significant cryptocurrencies, but no one is using it for its intended purpose, which was literally to bypass the existing monetary system. A lot of people are seeing it as an investment rather than as money. And I think that goes against the very foundation of its original target. So I'm going to hand over to Carl. Carl?
Yeah, Wes, it's a good question. I think, developments around the adoption of blockchain are happening at light speed. And the technology is certainly expected to play an important role, certainly in the next 10 years. But not to put a dampener on things, there are some issues that I think investors need to be pretty mindful of. And one of those being sort of a lack of clear regulatory framework, which is preventing sort of the adoption of cryptocurrencies as part of any institutional investment type framework. And then another one of those issues that, you would have seen recently in the media is the consumption of dirty energy, which is obviously an important issue for any ESG compliant investors. And then lastly, but quite importantly, particularly for us, is really the absence of consensus around any sort of valuation methodology, which makes it quite difficult to value any sort of cryptocurrency. But much like the evolution of internet stocks, that we hope that as the industry develops and matures, we might sort of get some traction on that. But again, this is a very exciting space, and we're certainly keeping abreast of developments. But because of kind of what we've just highlighted, it's not possible for us at this time to really include cryptocurrencies necessarily as part of our coverage.
Okay, thanks for that, both of you. Carl, we're getting a lot of questions regarding the future of inflation, as well as the impact on the right portfolio mix. So, maybe you can just guide the audience here briefly.
Yeah, absolutely. Inflation is really on the top of everyone's mind at this point in time, and for good reason. If I look at the situation locally, our May numbers came in at 5.2% versus our April numbers of 4.4%. So a decent uptick in the last short while. But this is, again, still well within our sort of 3 to 6% range that the SARB has set for us. And really some of the big drivers of that increase were increased food costs and increased transport costs, as well as base effects. So I think if we look at, what's happened in the oil market over the last 12 months, that's not necessarily that surprising, and pretty much in line with what's happening globally. Again, I think, the big debate at the moment is whether inflation, is transitory or is it, here to stay. But I guess, more important and to the point is, where's inflation going in the next 12 months? And if you have a look at kind of market expectations, they're firmly anchored around that sort of 4.5%, so midpoint between the sort of 3 and 6% mark. And maybe just an important point on this, I don't think it's necessarily that important, whether inflation's at perhaps 4.5 or 4.8%. It's really the sort of the risk that inflation runs sort of consistently higher than perhaps the sort of 6% mark, for an extended period of time. And if you look at sort of SA and sort of the economic backdrop that we're operating in, I think that this is very unlikely.
Okay, Carl, thanks. I'm just going to keep you in time there. I could see you were going to go on for a while, but getting that, we're going to keep to the SARB brackets for inflation.
Yeah.
Okay, perfect. And then just on the portfolio mix, how would people structure, how would this affect their portfolios?
Yeah, so this is probably not an easy question or as easy as it would seem at the outset. I think everyone's financial position obviously differs, and so do their needs and goals. But at Nedbank, we like to lead with an advice-first approach. So I'd certainly encourage everyone who'd like us to have a look at their holistic wealth needs to please get in touch with us. We can make sure that we get the right advisor in front of you, who can then pull in specialists like myself and yourself, in fact, Wes, just as an example.
Okay. No, perfect. Thanks for that, Carl. Next question. What are our views on the Rand-dollar exchange in the future, 3, 5, and 10 years out? So I think this is a nice curveball question. Maybe just a quick response from both of you. I see we're running out of time. We've got about 4 minutes left, yeah?
So I think I'll let you handle that. I don't think any investment professional is necessarily thrilled about answering a Rand question 20 years out.
If we take a look at the Austrian school of thinking, it's about evaluation of productivity levels between countries, and literally meaning that our currency will then be linked to our productivity as compared to our trading partners. And that means that if our productivity declines, so will the value of our currency.
Okay. Carl, you gonna add in?
Yeah. So look, the Rand is certainly a big part of the investment landscape in South Africa. I think it's important to just add that we as a house don't necessarily forecast where the Rand is going to be at a specific point in time, but we certainly like to keep an eye on where it's going directionally. And for this, we use tools like purchasing power parity to really give us an indication as to whether a currency is looking relatively expensive or relatively cheap versus another. So I think looking back over the last 20 years, the Rand certainly has weakened quite a bit against the dollar for several reasons. One of those being sort of interest rate differentials between the SA and the US, just as an example. So I think, perhaps in the long term, we certainly don't think that we certainly think that this trend would continue. But like any heavily traded market, currencies can be very volatile in the short term. And what we have seen is after periods of significant weakness, such as 2016, and even last year during the sort of height of the COVID-19 sell-off, we do tend to see sort of prolonged periods of Rand strength, which is what we've probably seen, going back probably a year and a bit now. And we'd expect this short-term trend to probably play out a bit longer.
Okay. No, thanks for that. Just conscious of time, we're getting a lot of questions coming through about when to start investing in stocks, the best investments from a cost perspective, where should the youth of today be investing, what are the best tax-free investments. So I think, just to show you guys that I'm in control here, Carl and Pieter, I think I'll add a little bit more value from my side as I'm feeling a little bit left out, and I'll answer here. So, tying all these various questions, I mean, there's so many coming through on the chat. I just want to tie these all into one solution. And I would say, you definitely need to explore a tax-free investment savings option. I mean, that's where we'd all start, And I mean, these are all provided by all large financial institutions where they'll allow you to invest up to 36,000 Rand per tax year into this account, and there'll be no tax charged. Another benefit is a lot of these institutions are, they're playing ball, they're coming to the party, and they're reducing a lot of their costs that are associated with these tax-free investments. So, I mean, this is a great place to start. And I mean, just as an example, I mean, here at Nedbank Private Wealth Stockbroking, we allow clients to buy from a list of, pre-approved exchange-traded funds. And I mean, these ETFs offer clients great diversification, and especially when you're combining a lot of these ETFs into this tax-free account, it's there's great added benefit. What we also do is, I mean, just with a reduced brokerage rate, costs do play quite a significant part in your investments. So this is a great place to start your investing journey, as well as to, if you've got existing accounts, this is a great way to add on to your accounts by having this added tax benefit for your future savings. I'm just looking at the time. So unfortunately, our time has come to an end for this Q&A session. Thank you so much for your participation. I mean, there's numerous questions coming in from the group, from this forum. I mean, I can maybe just nitpick one or two, but we can maybe potentially stay on after this. But yeah, thank you for your participation. Again, please feel free to resend your questions and your email addresses so we can get back to you in a timely manner. Carl, Pieter, thank you so much for those insightful answers. It's been short, and sorry, I've kept you a little bit tight, but I've tried to keep as best as we can to our time limit. And I think the audience have actually appreciated your expert feedback. I'm going to hand over to Carl again for a brilliant close. Thanks, Carl.
Yeah, thanks very much for that, Wes. So I think, in closing, I'd just like to say that perhaps while it's easy to look at the negatives, the risks, the things that don't necessarily always come off, I would urge you to look at the potential benefits that could come from any number of ideas, because the upside, could be very exciting. So this is in no way investment advice, but I do think that some of the great investment ideas over the last decade have needed a healthy dose of imagination. Thank you to both Pieter and Wesley for your time today, and a very big thank you to everyone who joined this call. If you'd like to be invited to our spin-off session in the next couple of weeks, please drop your email address and name into the chat box, and we'll send that invite through to you. For now, take care and be safe out there.